This is Cnbc's Worldwide Exchange.
I'm Christine Tan here in Asia. Most markets fall as fresh record oil prices spark inflation fears.
And I'm Brian Jackman in the U.S. with high energy prices hurting consumers. Congress preparing to grill top oil executives.
And I'm Ross Westgate. In Europe, German business sentiment surprises. The IFO survey rose in May, sending the euro higher. Right, we're just waiting for minutes out of the Bank of England's last meeting. We think that they voted 8-1 to keep rates on hold at 5%. We'll get those minutes out in around about 30 seconds' time. Ahead of that, the big surprise, of course, in the last half hour has been that rise in the IFO sentiment survey. It's had an impact on the euro. It sent it up nearly 0.5% higher against the dollar. And global equities took a slight boost from it. The Cnbc Global 300 up around 6 points. We hit our session high after that IFO number. German equities got a bit of a boost as well, although just settling back now to the flat line. Of course, we had some 1.5% fall yesterday for German equity markets. Right, we are now getting the minutes out from the Bank of England right now, and I'll tell you exactly what happened. The MPC, as expected, voted 8-1 to keep the bank rate at 5%. No surprise that Mr. Blanchflower wanted a 25 basis point cut to 4.75%. The majority on the Bank of England said the cut could hurt CPI expectations. CPI, of course, as we know from last week's inflation report, expected to accelerate further in the near term. They say on the MPC that some slowing in output growth is necessary, and an immediate cut would suggest the MPC focus is on output. Mr. Blanchflower, meanwhile, says there's a clear risk of CPI being below 2% further ahead, and there's little chance of above-target CPI persisting. He said the upward factors are beyond the MPC's control and that UK pay growth remains subdued. Let's get a reaction to that. Joining us is Tom Voser, Head of Market Economics in Europe for NAB Capital. Tom, sterling just rallying a little bit on the back of that. Look, no surprise that the majority here want to stay their hand after the inflation report. I suppose the question is how much credence do you give to what Mr. Blanchflower is saying? Look, the CPI is beyond the Bank of England's control. It's not going to be a problem in the future, and that pay growth remains subdued, because that is the key if you want to cut rates.
Indeed, it's this whole question of second-round effects. Blanchflower is saying, I don't believe we're going to get any. If anything, the labour market will be slowing towards the end of the year, so I'm not looking for wages to increase. Therefore, inflation will return back to target. The other MPC members are saying, well, hang on a minute. We're still seeing high oil prices. We still haven't yet seen the full feed-through of food price inflation. And yes, OK, the labour market might be cooling, but that doesn't mean the workers aren't going to demand higher pay. If we look at where the public sector unions are at the moment in the UK, clearly there are some risks there for wage inflation.
So who's right, Tom? And what does it mean for whether we get an interest rate cut this year?
We think it's now increasingly unlikely that we'll get a cut this year. Certainly, we suspect there'll be now 3 letters being written by Governor King to Chancellor Darling in the 5 months to December, when inflation is well above 3.1%. Having said that, there might be some space in early 2009, but we're now essentially in a world in which Bank of England rate cuts will be dependent on the path of oil prices.
And Tom, look, I know we're going to talk about the minutes in the US. I just want to get your view on that iPhone number, though, as well. Look, Mr. Nerve said we think there should be a rate cut in the autumn, but with a strong iPhone number like that, and he's forecasting GDP growth up at 2%, is there any chance, I mean, is a rate hike more likely than a rate cut from the Eurozone?
Still think there's a chance of a rate cut. Remember, yes, the main iPhone number was a little stronger than expected, but if we look at that current assessment component, which is the bit which really ties in nicely to with GDP, it is showing a slowdown from the high point that we saw in March. So Q2 German GDP will be slowing. We still suspect that part of Q1 is really due to the leap year effect. German seasonal adjustment isn't all it's cracked up to be. And so, again, there is some scope for the ECB to cut rates, but, again, they'll be wanting to see no emergence of second-round effects and perhaps a broader-based slowdown, particularly in France and, again, in Spain.
Tom, it's Brian here in the U.S., and Ross touched on it. We have the FOMC minutes coming out as well today. There are some indications that there could be some strong language about a pause in the cutting cycle that we've seen so dramatic in the last few months. What's your sense of what we'll see and read and hear, but also do you think the sentiment is still true today?
I think it's fair to say, if we look at Vice Chair Cohn's speech yesterday, that with that increase in oil prices, there is perhaps a greater likelihood that the FOMC may decide to pause for a while as they look at the landscape. Now, we know that in the statement that accompanied that meeting, the FOMC removed the phrase about the downside risks of growth. They felt that they'd cut so aggressively and that with real rates being negative, that in essence they had controlled now the risks to growth. I suspect that is really the feel that will come through from the minutes. Of course, we will be looking for any hints that more members than the two who simply dissented actually feel that they've reached the end of the easing cycle.
Hey, Tom, stay with us because, of course, we know that oil is impacting inflation as well. Let's bring in our other oil specialist. We have Jonathan Conifel. He's from Asia Hudson Capital Energy. Jonathan, you've heard what Tom was talking about in terms of inflation. We want to talk about oil. When you see that spike in oil trading above $129 a barrel, is it Boone Pickens that's making the calls in the market, that's impacting market sentiment, or is it just simply the rollover in the contracts we saw yesterday?
Right. Well, I think right now the oil market is in the middle of a frenzy of bullish activity, and I think Boone Pickens is just one part of that. It's really short-term factors that have pushed the market up recently. There is no scope right now for either a decrease in demand or an increase in supply, and that is really what has gotten us up this last $20. It's really, you have to look right at the diesel market, the middle of the barrel market, which is a huge demand coming out of China because they're lacking in coal right now, and they're having problems, obviously, in the disaster in the Sichuan province right now. And the Beijing Olympics coming up also. There's also problems in the Middle East in terms of electricity to power their economies, their growing economies. Power failures, they're turning to diesel also. That is really the main factor right now behind this recent rise, and there's no real change on the horizon to affect that.
And speaking of real change, there is speculation in the market today, especially in Hong Kong and China. This turnaround we saw in the markets led by the refiners on talk that maybe China could actually start to raise state-set prices on oil products. It's only a matter of time, right? Right.
Well, it is only a matter of time. And subsidies have an enormous impact on where we are, the entire curve being where we are today in the crude market. For the last couple of years, the majority of the demand increase, almost all of the demand increase, has been from emerging markets. 70% of emerging markets are subsidized. So these economies that are growing and they're becoming more and more wealthy, their consumers don't pay the market price for gas. So whenever you hear Indonesia or China, whoever it may be now, talking about raising the subsidies or getting rid of the subsidies, that is really the only factor that can actually pull the market down. That is the biggest factor, in my opinion.
I want to bring back in Tom for the conversation. Tom, we've talked a little bit about inflation, and you talked about what the Fed's involvement. When it comes to oil, with the PPI numbers we saw in the U.S. and then the CPI from last week, it is alarming to see this huge spike in oil, but we have not seen this huge spike in inflation. Does that mean the knock-on effects are on the way, or is there some sort of disconnect?
Well, we think in terms of headline inflation, the knock-on effects are clearly on the way. But then if we think through a big spike in oil, obviously in the States as we start the driving season, people have to fill up their cars with gasoline. It gives them less money to spend elsewhere. And it's within that context that we'd look at the 66% drop in Home Depot profits that was announced yesterday and then say this is what we'd expect to ripple through further. Disposable income in the West is getting crushed by high energy and food prices, and we're still amazed that particularly equity markets are still so strong.
Yeah, so Jonathan, does that mean, frankly, everybody always got worried if oil prices went up, there'd be a certain point where, look, it'd be too expensive and demand would drop off. I mean, actually, we're all addicted here. We can't, no matter how expensive it gets, are we just going to keep the demand levels the same?
Right. Well, whatever the demand drops off in the United States, you're seeing demand increase in other parts of the world. So as I said a minute ago, it really has so much to do with these subsidies. And until the Middle Eastern countries and these Asian countries that have the subsidies, until they stop the subsidies, you're not going to see the price come off. It's really as simple as that. That's what it comes down to.
Talking about demand destruction, right?
Yes. Absolutely, yeah.
So, Tom, look, here's the thing, right? So picking up on that, if the price isn't going to come down, what happens with second-round impacts? Okay, for I don't care wherever you're talking about. Are wages going to go up or not?
Well, we suspect that with growth being below trend in the US, in the UK, and perhaps slightly in the Eurozone, the wage pressures will be muted. But if we do see oil remaining at these levels until the end of 2009, which is where the futures strip would currently tell you that Brent will be around $126 for a long period of time. Of course, inflation starts to dip in 2009 because the prices don't move any higher, but certainly I think we'll try and see wage bargaining. Whether or not that materialises remains to be seen, but it will put upward pressure on wages.
All right, Tom, we'll have to leave there. Thank you very much for being with us. Tom Vosa, Head of Market Economics in Europe, NAB Capital, and Jonathan, pleasure to have you as always. Thank you very much for dropping by.
Thank you, it's a pleasure.
That was Jonathan Conefeld, Director, Asia Hudson Capital Energy, LLC. Well, we spoke a lot about China. Shares there rebounded nearly 3% today thanks to a surge in shares of energy giants. Chung Lei joins us now live.